Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Shell PLC. We're looking at Shell today because similar to their British peer BP, Shell stock has performed very well over the past year. So their stock price and their stock chart will not be up to date here, as this ticker symbol was indicative of the changeover from the business from trading under RDSA to now trading under SHEL. But all of the financial information we'll be looking at for our analysis is up to date. So Shell is currently trading for $57.72 per share. Over the last year, their stock price is up nearly 30%, and currently they have about a $204 billion US market cap. For more background about Shell, Shell is an integrated oil and gas company that explores for, produces, and refines oil around the world. In 2021, it produced 1.7 million barrels of liquids and 8.7 billion cubic feet of natural gas per day. At year-end 2021, reserves stood at 9.2 billion barrels of oil equivalent, 50% of which consisted of liquids. Its production and reserves are in Europe, Asia, Oceania, Africa, and North and South America. The company operates refineries with a capacity of 1.8 million barrels of oil a day, located in the Americas, Asia, Africa, and Europe, and sells 15 metric tons per annum of chemicals. Its largest chemical plants, often integrated with its local refineries, are in Central Europe, China, Singapore, and North America. The company was formerly known as Royal Dutch Shell plc and changed its name to Shell plc in January of 2022. Shell plc was founded in 1907 and is headquartered in London, the United Kingdom. So for our analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Shell based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into our analysis. In just a minute, we'll talk about Shell's financials, but we have to address something first. What are some of the qualitative aspects around a potential long and a potential short thesis for the business? So starting with some of the main points around a potential long thesis for the business, downstream returns should improve as Shell reduces its downstream footprint to 6 integrated refining and chemical facilities, while reducing fuels production and increasing higher value chemical volume. Point number 2, Shell's energy transition strategy differs slightly from peers in that it is pursuing a low capital intensity business, managing power needs for customers, as opposed to investing in renewable power generation capacity. And number 3, Shell stands to benefit from the rise in global gas demand and likely strong prices over the next decade, as LDN becomes integral to managing renewable intermittency. Then for some of the key points around a potential short thesis of the business, Shell's transition strategy fails to fully satisfy either oil or ESG-minded investors, leaving both avoiding the shares, resulting in a trading to discount to more focused peers. Point number 2 is that although management is appealing, recent court orders in the Netherlands to reduce emissions well beyond the company's current targets introduces another element of risk associated with the energy transition. And point number 3, Shell's large LNG position puts it at risk if renewable power generation grows faster than expected or intermittency issues are solved, meaning natural gas will no longer be needed as a bridge fuel. Hopefully that offered a balanced perspective around some of the qualitative aspects of the business. Now let's get into their financials. So starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. There are 2 major reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital. So by looking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Shell is a commodity business as an integrated oil and gas company, so their returns on capital are going to fluctuate with the pricing of commodities, meaning that even though they're an energy company, they're a somewhat cyclical business, with the oil and gas sector being prone to boom and bust cycles. Shell, similar to its closest peer BP, had negative returns on capital in 2020, and in these other years, they're earning just about average returns on capital. Over their last 12 months, Shell has produced about 18% returns on capital. However, averaged out over these last 5 fiscal years, Shell is only producing about 5% returns on capital. So that's both below that 14% mark we're looking for, and it's below the returns of an average business. So this is an X here to start off on metric number 1. Next up, for metric number 2, here we're taking a high-level overview of the growth of the business. So we're looking for revenue, earnings, and free cash flow growth over the last 5 years. And this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of them is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So over this time, even though their revenues have been pretty up and down, and they fell pretty dramatically from 2019 to 2020. Shell has actually grown their revenues by about 20% overall when we include their last 12 months. Again, from 2017 until currently, their earnings have more than tripled over this period. They only had 1 year where they had negative earnings, and that was in 2020. And probably the best overall is that their free cash flows have more than doubled. And in all 5 of these years, Shell was producing positive free cash flows. That's important because free cash flow is really the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. So a business can use its free cash flows to reinvest back in the business, pay dividends, buy back shares, make acquisitions, or pay down debt. So it's great to see that even in a year of hardship like 2020, Shell was still able to produce positive free cash flows. All 3 of these numbers are up here for metric number 2, meaning that metric number 2 is our first check today. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Shell on a per share basis. So we're looking for earnings per share growth over the last 5 years. So we learned that in the previous metric, their earnings have more than tripled over this time. However, earnings are just the numerator in this earnings per share equation. We also want to take a look at what the denominator has done, how Shell has either bought back shares or issued new shares over this time frame. Fortunately for existing shareholders in the business, Shell has repurchased about 9% of their shares outstanding. So they've not only increased their earnings, they've also decreased the number of shares that they have outstanding. And so this is strong earnings per share growth here from metric number 3. This is another check, and this is important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business buys back shares, they're decreasing the number of shares that they have outstanding, which is going to increase your ownership percentage in the business, which ultimately increases the percentage of the business's profits that you're entitled to. They do this without you having to lay out any additional money, and it's almost as if Shell is making an acquisition of itself. So just like with any other acquisition, we want it to make sense for the business's owners. We want them to be getting more long-term value than the price that they're paying for their buybacks, and ultimately adding value for existing shareholders going forward. You'd have to do some more research to truly understand whether this is the case or not. Nonetheless, this is another check here on metric number 3. So far through our first 3 metrics, we have 2 checks and 1 X. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. We learned in metric number 2 that their free cash flows have more than doubled over this time, and Shell's bought back 9% of their shares outstanding. So this again equals strong free cash flow per share growth. This is another check on metric number 4, and we have 3 checks through our first 4 metrics. Then next up for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are at the greatest risk of potential poor outcomes. So Shell has had quite a bit of debt in past years. They had a huge net debt position of nearly $78 billion in 2019. Since then, they've been aggressively paying this down. They ended 2021 with $52 billion worth of net debt, and currently they have $46 billion worth of net debt. And over the last 5 years, Shell has produced about $107.5 billion worth of free cash flow. So that is plenty of free cash flow to be able to support this, in absolute terms, large debt load. But relative to their ability to produce free cash flows, it does look like Shell is using a reasonable amount of debt in their business. Additionally, over their last 12 months, Shell has produced $31.7 billion worth of free cash flow alone. So they'd be able to pay off all of their net debt with only a year and a half of their total free cash flows. So it does look like Shell is very strongly cash flow generative, and seems like their business is not overly levered relative to their abilities to produce free cash flows currently. This is another strong check on metric number 5. And through our first 5 metrics, we have 4 checks and only 1 X. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium to the rate of the 10-year treasury yield and potentially give us another reason to be interested in Shell. So again, their charting information is not up to date, but currently they have about a $250 billion total enterprise value. We're using their total enterprise value because it's taking into account both their market cap and their net debt position, and it's going to give us a more accurate picture of the economic reality of the business, more similar to as if Shell were a private company. Right now, Shell's trading for about the same total enterprise value that they had back in October of 2021, and we learned that in their last 5 years, Shell has produced about $107.5 billion worth of free cash flow, which means that in an average year, they're producing about $21.5 billion worth of free cash flow. So when we divide their $21.5 billion of free cash flow by their $250 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of about 8.5%. So that is above that 5% mark we were potentially looking for, meaning that on an average basis, this is a check here on metric number 6. Also worth being aware of that we pointed out in our previous metric, Over their last 12 months, they've earned about $31.5 billion worth of free cash flow. So to get a current free cash flow to enterprise value yield for the business, when we divide their $31.5 billion worth of their last 12 months of free cash flow by their $250 billion total enterprise value, that gives us about a 12.5% current free cash flow to enterprise value yield. So either way you slice it here, on both a current and an average basis, it does look like Shel is potentially offering us a risk premium, especially in comparison to the rate of the 10-year treasury yield, meaning that Shel is potentially an interesting company to dig in and do more research on. Just because this is a check here on metric number 6, does not mean that you're going to run out and buy the business. This is only one of 6 of our metrics. This analysis is not meant to be financial advice. It's not a buy or sell recommendation of any security. Instead, it serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Shel. And we'll talk more about that, but first let's cover some more interesting aspects of their business. So as a bonus, here we're taking a look at Shel's dividend profile. So right now, Shel is paying out about a 3.4% dividend yield, which is a yield that's twice as good as that of an S&P 500 ETF. However, it's easy to make mistakes by blindly chasing dividend yields, so instead it's important to stop and look at the underlying fundamentals of a business and, depending on the type of business, determine whether their dividends are well supported by either their earnings or their free cash flows. For Shel, we want the business's dividends to be supported by their free cash flows, and it looks like in 4 out of these 5 years that was the case. Shel only did not support their dividends in 2017. Since 2018, they've been able to do so, and really since 2020, they paid out a smaller percentage of their cash flows as dividends each year. They've managed to strongly grow their cash flows over this time, and they've also cut their dividends per share by nearly half. So it looks like Shel is in a pretty healthy position to keep paying out dividends, especially relative to the cash flows that they're bringing in more recently. And it would seem like their dividend is in pretty healthy shape going forward, especially as they prioritized repaying debt, and they're in a healthier position on their balance sheet overall. Then finally, here we're using a discounted cash flow model to come to a potential fair value for Shel. So starting with an average of their free cash flows over their last 5 years. So this is below the amount of free cash flow per share that they're currently bringing in, which has increased recently on the back of higher oil and natural gas pricing. Then using historical growth assumptions for the business based off how Shel has been able to grow their free cash flows dating back all the way to 1998. If we assume a growth stage for the business over the next 10 years where they grow their average free cash flows at a rate of just under 4% annually, then assuming a terminal stage for the business where their free cash flows decline at a rate of 3.5% annually over the 10 years out after that. So those are historical growth assumptions that you need to do your own homework on to determine whether or not those are going to be potentially accurate and applicable here for Shel. Then if we were seeking a potential 10% rate of return going forward on the business, it looks like a fair value for the company is around $64 per share. So if these are accurate inputs as a projected baseline estimate for Shel over the next 20 years, then it does look like there is a slight margin of safety in their current stock price if you're satisfied with a potential 10% rate of return. There are a number of reasons why this would not be potentially accurate, and so it's up to you to do your own homework here. Additionally, keep in mind that this 10% rate of return would be including their dividends. So 3.4% of this would be, and that's how that would be returned to shareholders. So their stock price would not be increasing by 10% annually. Also, it's worth being aware that a discounted cash flow model, just like any other model in any other discipline, is going to have its outputs be sensitive to its inputs. So through deeper research, you'll understand if these are really accurate and applicable or not. Then most importantly, this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, Shel checks the box on 5 out of 6 of our metrics. They're only off with their average returns on capital being slightly below that of an average business. However, their business has grown across all fronts here. Their revenues, earnings, and free cash flows are up. They've also bought back 9% of their shares outstanding, meaning that on a per share basis, these numbers are up as well. They're using a reasonable amount of debt relative to the free cash flows that they're able to produce from their business. And on both a current and an average basis, it looks like the business is potentially offering us an attractive risk premium based off how they're able to produce free cash flows relative to their total enterprise value in comparison to the yield of the 10-year treasury. Then it looks like their above average dividend is also in good shape based off their abilities to produce free cash flows. And finally, performing a discounted cash flow analysis of the business, again using those historical growth assumptions. If you've done the work and you've validated those assumptions and you're satisfied with a 10% rate of return, then it looks like there is a slight amount of margin of safety in Shel's current stock price. It's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with your financial advisor. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. but over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. As a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can understand the essence of the business and understand what's important and what's not important for that company going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects about Shel as a business, and you'll likely be able to determine for yourself what a reasonable intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Shel PLC, ticker symbol SHEL. Again, want to apologize because their stock price and the charts that we've seen of their stock price and their total enterprise value have not been updated here. But again, reiterating that all of their financial data that we've seen is up to date and is accurate for Shel as a business. We looked at Shel today after looking at their main competitor BP, and we'll be continuing to look at a number of other energy businesses. I'm happy to analyze these companies and hopefully you learned something. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Shel with me and have a great day.